Your fixed rate mortgage is about to end, but your income isn't what it used to be. Whether you've just lost your job or taken a lower paying role, you're now staring down the barrel of sky high repayments at today's rates. So what can you do? When your fixed term ends, you're automatically moved onto the lender's standard variable rate, which is almost always higher than your previous rate. But if your earnings have dropped, remortgaging can feel impossible. The banks want proof of income, the affordability checks feel stricter than ever, and the rates brutal. In this video, I'm going to break down your real world options, whether you're earning less, on benefits, self-employed with unstable income, or just trying to get payments as low as humanly possible. If you're serious about getting ahead financially, whether you're a homeowner, landlord, or first time buyer, do me a favor, hit that subscribe button. Now let's get into it. The problem: fixed term ends, costs jump. Let's start with what actually happens when your fixed term ends. Most UK fixed rate mortgages last 2, 3 or 5 years. Once that period ends, you move on to the lender's SVR. Right now, that SVR can be anywhere from 6% to 8% depending on your lender. Let's break that down. If your fixed rate was 2% and you had a £200,000 mortgage over 25 years, you were paying around £848 a month. At 6.5%, that same mortgage jumps to around £1,350 a month. That's an extra £500 every month, or £6,000 a year overnight. Now, if your income has dropped, that hit becomes even more painful. Worse, you may not even qualify for a remortgage under traditional lending criteria. Why lower income makes this harder? Lenders assess your affordability based on your income, expenses, credit history, and debt to income ratio. If you've recently quit your job, gone freelance, taken a lower paying role, or had reduced hours or income due to illness, you might not meet your lender's criteria anymore, even if you're managing your current payments just fine. That's because affordability rules look at future risk, not just past behaviour. And lenders are often more cautious when rates are high, especially if your income is unstable. So remortgaging becomes trickier, but that doesn't mean you're out of options. Option 1, stay with your current lender. This is the easiest and often safest option if you're struggling to qualify elsewhere. Many lenders will let you do a product transfer, which means switching to a new fixed rate with them without full affordability checks. Why? Because they already have a relationship with you. They know your payment history. You may not get the absolute best rate on the market, but it will almost certainly be lower than the SVR. Example, your SVR is 7%, but your lender offers a 2-year fixed at 5.5%. That's a significant saving and no hoops to jump through. An important note is some lenders require you to switch before your term ends. So don't wait for the last week, start talking to them 3 to 6 months before the end. Option 2, remortgage elsewhere. If you want the best rate on the market, you may need to remortgage to a different lender. But with reduced income, you'll need to be smart. And here's what can help. Use a whole of market mortgage broker, especially one used to dealing with complex cases. Consider a longer term. For example, switching from a 20-year term to a 30-year term to lower monthly payments. Look at interest-only options. This is a short-term solution, not really a long-term strategy. Provide additional income evidence, like freelance contracts, benefits or pension income. Consider a joint mortgage if your partner or a relative has stronger finances. You'll need to pass affordability checks, but a good broker can package your case in the best light and match you with a lender that's more flexible. Option 3, extend your term. Extending your mortgage term reduces your monthly payments by spreading the cost over a longer period. Say you have 15 years left. Extending to 25 years could reduce your monthly costs by hundreds. The trade-off? You'll pay more interest overall, but it can ease short-term cash flow. Many lenders will let you extend if you haven't missed payments, even if your income has dropped, as long as it still looks manageable. Option 4, temporary interest only. This can be a lifeline. Some lenders offer temporary interest only arrangements, often for 6 or 12 months. That means you only pay the interest, not the capital, slashing your monthly bill. This is great for people between jobs or waiting for income to recover. It won't reduce your debt and it may affect future borrowing, but it buys you some time. Speak to your lender about forbearance options if you're struggling. Option 5, switch to tracker. Trackers follow the Bank of England's base rate, so they can go up or down. Some lenders offer tracker deals with no early repayment charges, which gives you flexibility. If you think interest rates might drop in the next 12 to 18 months, this could save you money short term, but it's a gamble. If rates rise again, so will your payments. The one thing you should not do, ignore it. Doing nothing is the worst move. If you roll onto the SVR and hope for the best, you could be paying £200 to £800 more every month unnecessarily. Even if you're unsure what to do, talk to your lender or a broker. They'd rather help you restructure than see you fall into arrears. And the earlier you speak to them, the more options you'll have. Checklist: what to prepare for your lender or broker, your latest pay slips or proof of self-employed income, any benefits award letters, universal credit, child benefit, etc. Bank statements showing regular income, mortgage statement, credit file. Give it the once over and make sure there's no anomalies. A budget showing your monthly income and expenses. Having this ready will make your application smoother and show the lender that you're responsible and proactive. Bonus tip: mortgage charter protection. The UK government and major lenders signed up to the mortgage charter. This gives you extra protection if you're struggling. You can switch to interest only for 6 months, extend your term temporarily, no repossessions within 12 months of missed payments for residential borrowers. It's not a free pass, but it's a safety net. Use it if you need to. So, what should you do if your fixed mortgage is ending and your income is lower? Well, start early. Speak to your lender, know your options. Product transfer, remortgage, extend term, interest only, tracker deals, and government support. There's no one size fits all, but there are always options if you act before it's too late. Have you faced this situation? Fixed term ending with less income than before? Drop your experience in the comments. You might help someone in the same boat. If you found this video helpful, do me a favour, hit that like and subscribe button. I'll catch you on the next one.